Why is it that in the largest, most powerful financial market in the world, a market that now moves over $7 trillion a day, most traders still lose? Why do so many chase this ocean of opportunity, only to drown in its first wave? It's not because they're lazy. It's not because they're stupid. It's because they brought a beach towel to a hurricane. They thought Forex was a game, a way to get rich quick, a click-and-collect money machine. What they didn't know is that this ocean doesn't forgive. There's a hidden current running beneath every chart, every currency pair, every news headline. It pulls on greed. It whispers promises of freedom. It offers leverage like a gift, but demands blood in return. And every year, hundreds of thousands of beginners jump in and never come back. You see, the Forex market doesn't reward speed. It doesn't care how much you learned in a $997 course. It doesn't care if your MetaTrader has a dozen indicators. What it rewards is understanding, discipline, the kind of mindset that sees patterns in chaos and doesn't flinch when the wave comes crashing. But here's the secret that almost no one tells you. Those who survive the tide don't just float. They learn to sail. And eventually, they learn to command the entire ocean. This video is not a tutorial. It's not a step-by-step guide. It's a survival map, told through stories, metaphors, and the brutal truths nobody dares to say. If you've ever wanted to master currency trading without falling into the same trap that swallows 90% of traders, you're in the right place. So let's dive in and start where most never even realize they're lost. The hidden current, understanding what really moves the market. It doesn't roar, it doesn't make a splash, but it moves the most money in the world every single second. The Forex market is like an invisible current, flowing underneath the financial system, shifting with every whisper of economic data, every political ripple, every global breath. And yet, most people walk right over it, unaware that the ground beneath them is liquid. Here's the truth. Forex isn't just another trading option. It's the bloodstream of the global economy. Over $7 trillion flows through it daily in 2025, more than the stock market, crypto, and commodities combined. But the power isn't in that number. It's in what it means. Constant motion, relentless liquidity, no sleep, no safety. Most beginners come into Forex thinking it's like buying Apple stock or investing in Tesla. They think it's about picking a currency that will go up. But this market is not about owning. It's about flowing. You're not buying something solid. You're entering a tug-of-war between two currencies, a tension, a relationship, a current. And that current can either carry you forward or pull you under. Imagine you're standing at the edge of the sea. The water looks calm, but one step forward and you feel it, the pull on your ankles. Subtle, deceptive, but it drags. That's what Forex is. On the surface, it looks like charts and candlesticks, but underneath, it's driven by invisible forces, central bank policies, inflation data, political tension, employment reports, global capital flows. You don't trade price, you trade reaction. You don't trade news, you trade expectation. And when you're wrong, the current doesn't just turn against you, it drags you deeper. Most people never realize this. They look at a chart, draw some lines, buy EUR, USD, and hope for the best. But they don't understand what they're stepping into. They don't see that every pair, EUR, USD, USD, JPY, GBP, CHF, is not a price but a pressure point. It's two economies wrestling in real time. Once you understand that, you stop guessing. You start listening. You don't fight the current. You learn to ride it. That's what professional traders do. They don't predict the ocean. They read it. And that's your first real shift. Stop thinking of Forex as a game of buying and selling. Start seeing it as a fluid battlefield, where your survival depends not on how fast you trade, but how deeply you understand what moves beneath your feet. The speculator's trap. Why hope isn't a strategy. They come in wide-eyed, inspired, hungry. They saw a video of someone trading from a beach. They heard you can flip $100 into $1,000 overnight. And in their hearts, they believe they'll be the exception. That they'll outsmart the market, outspeed the crowd, outsmart the system. But what they don't see is the drift, the silent slide that takes them from dreamer to debtor. Speculation is the soul of the Forex market. Over 90% of all daily trades aren't for business or trade. They're not for governments. They're not even for hedging. They're bets. Fast-moving, high-leverage, gut-driven bets. It's not a bug. It's the design. The very infrastructure of Forex was built to allow speculation, to let anyone, anywhere, bet on the rise and fall of currencies. And that is both the beauty and the trap. Because when something moves this fast, this freely, it creates the illusion of control. You click buy, the candle moves up, you feel like a god. You click sell, you make $120 in 6 minutes. Your chest swells, you think, I've figured it out. But what you don't realize is that the ocean let you win, not because you were smart, but because it wanted you in deeper, just like a gentle tide luring a swimmer off the shore. Then comes the shift, one bad trade, then another. You double down. It has to reverse, but it doesn't, because this market doesn't care about what you want. It doesn't care about how much you need rent. It doesn't even remember that you exist. The moment you enter a trade, you're part of a sea of anonymous forces. Hedge funds, banks, bots, and billions of dollars moving with no emotion, no mercy. That's why speculation, while it sounds exciting, is often just drift disguised as direction. You're not trading a plan, you're reacting, you're chasing, you're emotionally surfing a current you can't see. And the longer you drift without a strategy, the more likely you are to capsize. Real traders don't drift. They don't throw darts. They don't revenge trade. They anchor. They set a course. They define their exit before they even board the ship. Speculators, on the other hand, drift until the market gives them a lesson they didn't ask for and can't afford. So ask yourself, are you sailing or floating? The dual nature, every currency pair is a tug-of-war. You're not trading dollars. You're not trading yen. You're not even trading the euro. You're trading tension, a live tug-of-war between two economies, two belief systems, two worlds. Every currency pair is a seesaw, and until you understand both sides of it, you're just guessing which way the wind will blow. Most beginners open their trading platform and see something like EUR/USD or GBP/JPY. They focus on the first part. I think the euro will go up, so they click buy. But they forget the second part, the counter currency, is just as important, because Forex isn't about whether one currency is strong. It's about whether it's stronger than the other. It's not a race against a clock. It's a duel, a debate, and the winner decides the direction of the chart. Let's say you're trading USD/JPY. You hear the US economy is doing well, so you buy. But what if Japan just raised interest rates higher than the US? What if their inflation data crushed expectations? What if the Bank of Japan announced a surprise policy that shocked the market overnight? Suddenly, your strong dollar doesn't matter, because you didn't account for the other hand on the rope. Now imagine each currency pair as a tightrope stretched across an ocean. At each end, two titans are pulling. Governments, banks, central banks, economic data, inflation, war, trade deals, elections. And you're standing in the middle, trying to balance. That's why professional traders study both sides of the pair, not just the USD, but what's happening with the CAD, not just the euro, but what Germany's economy is doing, what the ECB is signaling, how France's PMI reports are affecting sentiment. Because the price is just the surface, the pair is the pull. Even the nicknames reflect this relationship. Cable for GBP/USD, a historic link that once transmitted financial quotes under the Atlantic. Loonie for USD CAD, because the Canadian dollar's strength is tied to oil prices and national quirks. Each pair has a personality, a rhythm, and if you try to trade it blindly, it's like stepping into a dance without knowing the steps. So, stop thinking in isolation. Start thinking in pairs. Ask, what is the relative strength? What is this pair telling me about how the world views two different economies? Because once you see the pair for what it is, a dynamic push and pull, you'll stop betting on hope and start trading on understanding. The never-sleeping ocean, trading in a 24-hour market. There's something seductive about a market that never closes. It whispers, opportunity is always here. It invites you in at midnight, teases you at dawn, dares you at lunch, and punishes you at 3 a.m. when no one's watching. But behind that 24-hour glow is a danger most traders never prepare for. The Forex market isn't like stocks. It doesn't shut down at 4 p.m. It doesn't take weekends off in the same way. It moves across time zones like a ghost ship, starting in Wellington, then drifting through Tokyo, lighting up London, and crashing into New York. It's a wave that never stops, only changes shape. At first, that feels like freedom. You can trade anytime, before work, after dinner, on your phone in bed. But that freedom comes at a price, because while the market is always open, you're not. You get tired, emotional, overstimulated, and the ocean knows exactly when to strike. Picture this. It's 2:30 a.m. in your apartment. You're half awake. The Tokyo session is heating up. You see a sharp spike on USD JPY. You jump in thinking, this is the move. But you didn't realize a BOJ official just spoke in Japanese on local television, something the algorithms picked up before your English newsfeed updated. That spike, it reverses in seconds. And now you're down 80 pips before your coffee even cools. This isn't just theory. It happens every night in every session, because each session brings different liquidity, volatility, and behavior. The Asia-Pacific session is slower, often yen-driven. The European London session is aggressive, fundamental heavy, driven by news. And the New York session is emotional, especially during US data drops or Fed announcements. Then there are the crossovers, London, New York, when volatility peaks like a storm front. Real traders don't just ask, what's the setup? They ask, what time is it? Because the same setup that works at 10 a.m. New York time might fail completely at 11 p.m. Tokyo time. Liquidity shifts, spread widens, reactions change. Even holidays play tricks. When the US takes a day off, London still trades. When Japan shuts down for Golden Week, the yen gets weird. When you're asleep, the market writes new stories without you. The 24-hour tide doesn't care about your sleep schedule. It rewards those who pick their moment, not those who chase every ripple. The ocean doesn't mind if you trade in the morning, the night, or the crossover. It only asks that you understand what kind of wave you're surfing. So, are you trying to catch everything, or are you choosing your window? The liquidity illusion when your lifeboat has holes. Liquidity. It's the word that makes every trader's heart beat faster. Deep liquidity, they say, means easy entry, easy exit. You picture a market so fluid that your trades glide in and out like a knife through warm butter. But here's the cruel twist. The very thing that seduces you can also be the very thing that sinks you. You've probably heard that the Forex market is the most liquid market in the world. That's true, on paper. Over 7 trillion changes hands daily in 2025. But that number is a mirage. Because not all liquidity is your liquidity. The deep pools, the ones that matter, are controlled by the whales, central banks, institutions, algorithmic bots, and they don't move like you do. Retail traders, they're like minnows darting in the shallows. You might get filled fast on a trade, but try placing a big position during low-volume Asia hours, and you'll watch spreads widen like a crack in a sinking hull. You'll see your order slippage spike. You'll see prices move without logic, not because of direction, but because of absence. Now let's talk about volatility. In theory, high liquidity should smooth volatility, right? But in Forex, volatility often dances when liquidity steps away. During the London-New York crossover, when liquidity is deepest, you also get the sharpest moves, because that's when the big players strike. That's when major economic reports hit. That's when institutional orders clash. And if you're not prepared, you're caught in the splash zone. Imagine sailing through what looks like calm water. Then out of nowhere, a massive cargo ship's wake swells beneath you. That's what happens when liquidity masks impact. You place a trade thinking, it's a small move. But behind the scenes, hundreds of millions are repositioning. And your little trade just got tossed around by a move that had nothing to do with you. And on the flip side, low liquidity can trap you in silence. You're in a trade, you want out. But spreads are too wide. Your stop loss gets skipped. Your execution gets delayed. You're screaming into the void, and the market doesn't respond. So, what do professionals do differently? They don't assume liquidity is safety. They treat it like weather. They check it before trading. They avoid illiquid hours like dead seas. They don't size up in choppy conditions. They don't mistake movement for opportunity. They observe the rhythm. When the market breathes, when it sleeps, and when it snaps. Liquidity can be your friend, but only if you respect it, only if you understand that it isn't always there to save you. Your strategic compass, why most traders sail without direction. You wouldn't sail into open waters without a compass, yet every day traders enter the Forex market with no strategy, just hope, noise, and a dopamine addiction to candlestick movement. They think they're navigating, but they're spinning, chasing waves, and the market, indifferent and infinite, lets them drift further and further from shore. What most beginners don't realize is that the market doesn't need to beat you. It just needs you to beat yourself. And nothing exposes you faster than not knowing your own plan. That's why strategy isn't optional. It's survival. It's your compass. Without it, every little spike feels like a signal. Every reversal feels personal. Every loss feels fatal. So, what is a strategy? It's not a set of indicators. It's not some secret moving average cross. It's a repeatable decision process. One that tells you when to enter, when to exit, and when to do absolutely nothing. And most importantly, it's a mirror. It reflects who you are as a trader, your goals, your time, your emotional limits, your strengths. Are you a scalper, hunting micro movements like a pirate watching the water's ripples? You'll need speed, discipline, and the ability to cut losses faster than thought. Are you a swing trader, patient, precise, waiting for storms to pass before you ride the wind? Then you'll need structure, story, and stamina. Or maybe you're a macro navigator, studying economic tides, interest rates, long-term trends. That means deep research and thick skin for slow burns. But here's what matters most. Pick one. You can't be all three. The scalper can't afford hesitation. The swing trader can't chase noise. The macro trader can't flinch at drawdowns. Mixing them, that's how traders blow up. They scalp until it doesn't work, then suddenly swing the losing position. They hold long-term only when the trade goes wrong. That's not strategy. That's survival panic dressed up as flexibility. Your strategy is your anchor in chaos. It stops you from reacting to every candle. It silences the voice that says, "This time is different." It gives you something rare in the Forex world, consistency. And that's the key, because the market doesn't reward brilliance. It rewards consistency. Anyone can be lucky once, but consistency, that's earned, that's built, that's calibrated with every trade, refined with every loss, and sharpened with every hard lesson the ocean throws at you. So before you place your next trade, ask, what's my compass? What am I following? Why am I here? Because without a compass, every tide feels right, until you realize you've drifted into a storm. The mind's hidden storm. Psychology is your greatest enemy. There's a hidden storm in every trader's journey, and it doesn't come from the market. It comes from within. It's the whisper that says, just one more trade, the panic that hits when a position goes red, the rush that blinds you after a win. This storm is emotion, and if you don't learn to navigate it, it will spin you into the depths. You think you're trading charts, candles, support, and resistance, but really, you're trading yourself, your fears, your greed, your memories of loss, your craving for redemption. And the market, it amplifies it all. It knows your weaknesses, not because it's sentient, but because it's made of people like you, making the same mistakes over and over again. Ask any experienced trader, and they'll tell you, the hardest part of trading isn't strategy, it's self-control. It's the silence after a stop-loss hits, the decision to walk away after 3 losing trades, the resistance to chase a breakout after missing the move. Now imagine this. You're in a winning trade. Price is flying. Your profit grows with every tick. But instead of closing the trade, you hesitate. You think, maybe I'll hold just a little longer. Then, snap, a sudden reversal. In a matter of minutes, you're back to break even, or worse. What just happened? You drowned in euphoria, in the whirlpool of more. Or consider this. You're in a losing trade. The stop loss is close. You feel the knot in your stomach. You think, it'll turn. It always does. So you remove the stop. Double down. Now you're not trading anymore. You're gambling, hoping, praying. But the ocean doesn't reward prayer. It punishes delay. And that's how a small cut becomes a fatal wound. That's the psychology whirlpool. It doesn't hit all at once. It spins slowly, sucks you in trade by trade, emotion by emotion, until you're no longer making decisions. You're reacting. So how do professionals escape it? They set rules, and follow them even when it hurts. They treat each trade as one of thousands. They don't trade to be right. They trade to be consistent. They don't tie their identity to wins or losses. They journal. They reflect. They build emotional armor, not to block out feelings, but to process them before they hijack action. Because here's the truth. You can't eliminate emotion from trading, but you can train your response to it. You can learn to feel fear and act anyway, to feel greed and still walk away, to feel regret and not revenge trade. The ocean doesn't care how you feel, but if you do, you'll make decisions that destroy you. the leverage trap, when power becomes your prison. It starts with a seductive number, 101, 201, even 501. Your broker says, with just $100, you can control $50,000. And suddenly, you feel powerful, like you've unlocked some secret weapon. Like leverage is your shortcut to fortune. But what no one tells you, not in the ads, not in the courses, is that this weapon cuts both ways. And if you're not careful, it doesn't just slice your account, it severs your future. Leverage is the ultimate illusion in Forex. It promises you control, magnifies your trade, but what it really magnifies is your risk. Every pip against you isn't just a small loss, it's a tidal wave. And with high leverage, that wave doesn't need to be big to sink your boat. Let's break this down. You open a trade using 100.1 leverage. That means a 1% move against you can wipe out your entire position. 1%, in a market that moves 1% in a blink. And that's without news. Add in a surprise central bank rate cut, a political crisis, or even a fake tweet. And your account isn't just red, it's gone, liquidated, zero. Now imagine doing that on a $10,000 account. You think you're trading small. It's only one lot, you say. But with leverage, that's $100,000 exposure. A 50 pip loss, that's not a paper cut. That's a hemorrhage. And if you stacked trades, if you overexposed, if you skip the stop loss, then your ship is already sinking. You just haven't felt the cold yet. The real danger isn't leverage itself. It's what it does to your mind. It tempts you to size up, to chase bigger wins, to recover losses faster. You forget patience. You forget process. You start thinking in terms of how much you can make, not how much you could lose. And that's exactly how the mirage works. You're thirsty. The ocean is vast. You think you see land, an oasis of fast profits, but you sprint toward it and sink into salt water instead. So, what do pros do? They use leverage like a scalpel, not a sword. They trade small even when they could go big. They calculate risk per trade, usually 1 to 2% of their account, and they never break that rule. They understand that surviving the next 1,000 trades is more important than winning the next one. Because in Forex, the goal is not to get rich quickly. It's to stay alive long enough to let your edge work. Leverage can build your fortune, or it can become the rope around your neck. It doesn't care. It just does what you tell it to. So, before you press that button, ask yourself, are you holding power, or is it holding you? The language of risk, understanding pips, and position sizing, they're tiny, almost invisible. A pip, a percentage in point, is usually just 0.0001 in value, 4 decimal places deep. But don't let the size fool you. In Forex, pips are like drops of water, harmless on their own, deadly in a storm. Because when you multiply them by leverage, by lot size, by time, they become waves. Waves that can lift your portfolio, or flood it completely. Let's demystify the pip. In most currency pairs, 1 pip equals 0.001 of a price movement. So if EUR/US moves from 1,050 to 1,055, that's 5 pips. Simple, right? But here's where it gets real. If you're trading one standard lot, 100,000 units, each pip is worth $10. 5 pips, that's $50. Now imagine a 50 pip swing. That's $500 in one move, and you only needed the pair to move 0.5%. But what if you're trading with 2 or 3 lots? What if your stop loss is 100 pips away and you haven't calculated your position size correctly? That's $1,000 gone. And it doesn't feel like much when the chart is moving fast, when the adrenaline is flowing, when your heart is louder than your logic. But when you zoom out, when the trade ends, you realize you didn't just lose a few pips, you lost your footing. Pips are the language of risk. They're how the ocean speaks to you. And if you don't speak pip, you're not trading. You're gambling. Because one wrong assumption, one uncalculated position, one overlooked decimal, and you're swept. Now think about this. Most people obsess over predicting price direction. Will it go up? Will it fall? But the pros, they obsess over the math, over the pip value, the risk-to-reward ratio, the stop-loss distance, the position size that keeps them alive, even if they're wrong 3 times in a row. That's the mindset shift. They don't count how many pips they want to win. They count how many they can afford to lose. Because they know survival is the real game. Not every trade is a home run, but every trade must be contained. In 2024, thousands of retail traders lost entire accounts not from bad predictions, but from bad pip awareness. A common story: a beginner placed a large position on GBPSJPY, forgot the pair moves in bigger pip chunks, and didn't adjust size. The result? A 120 pip whip destroyed their account in an hour. That's the danger and the opportunity. Because if you respect the pip, it becomes your ally, your warning bell, your guide to stay afloat. So, the next time someone tells you it's only a few pips, ask them, how many did it take to sink the Titanic? Your safety line? The stop loss as your last defense. In the wild sea of Forex, where waves of volatility crash without warning, your only true defense is something most beginners ignore until it's too late: the stop loss. It's not just a tool, it's your anchor, your invisible line drawn in the sand. It doesn't prevent the storm, but it keeps your ship from being dragged into the abyss. So, why do so many refuse to use it? Why do traders enter the market without a clear exit? Because the stop loss feels like surrender, like failure, like admitting you could be wrong. But here's the truth: a stop loss isn't about defeat. It's about staying in the game long enough to win. Imagine sailing without an anchor. The sea looks calm, but then the tide shifts. Your sails rip. You drift. And now, you're miles from shore. No control, no return. That's exactly what happens to traders who don't set a stop loss. They start with a small loss and hope. They say, I'll wait for the bounce. Then the bounce doesn't come. Then they add to the trade. And by the time reality hits, the loss is no longer manageable. It's total. A stop loss, used properly, is not just about protection. It's about discipline. It turns a losing trade into a calculated cost, not a catastrophe. It allows you to preserve capital, preserve confidence, and preserve mental clarity for the next trade. But not all stop losses are created equal. Place it too tight, you'll get stopped out by normal price noise, like panicking at the splash instead of the wave. Place it too wide, you're risking more than your strategy allows, and a single mistake could sink your account. The key is intentional placement. Your stop loss must be based on structure, not emotion. Behind support, beyond resistance, below a key moving average, or past a level that proves your trade idea is wrong. It must answer this question: at what price is my idea no longer valid? And here's the kicker: using a stop loss does something deeper. It frees your mind. When you know your risk is contained, you can trade with clarity. No more checking the chart every 30 seconds. No more praying. No more revenge trades. Just presence. In 2023, a wave of new traders jumped into USD CHF during a surprise Swiss National Bank intervention. Those who used stop losses escaped with minor scrapes. Those who didn't, accounts wiped. Not because the move was so big, but because they had no line in the sand. The market will move. That's its job. But whether it takes you with it or leaves you safely anchored is entirely up to you. Reading the ocean floor, chart analysis beyond the surface. To the untrained eye, a Forex chart looks like chaos, zigzags and candles, spikes and crashes. But to a seasoned sailor, it's a map, a living, breathing narrative of fear and greed. Every wick, every close, every formation tells a story. And once you learn to read it, you don't just see price. You see psychology. You see the ocean floor. Most beginners look at charts like tourists at sea, fascinated but clueless. They stack indicators like gadgets on a sinking boat. RSI, MACD, Bollinger Bands, Fibonacci spirals drawn like spaghetti. But here's the secret. The market doesn't follow your tools. Your tools follow the market. Before indicators, there was structure, price action, support, resistance, trends, consolidation, reversals. These are the currents beneath the waves, and they repeat. Not perfectly, not predictably, but rhythmically. Because humans don't change. Fear still looks like panic selling. Greed still looks like vertical candles. And doubt? It's sideways drift, the indecision before the storm. Picture this. A chart is the ocean floor, and your job is to navigate the terrain. Support zones are coral reefs. They catch falling price. Resistance is a shallow ledge, the ceiling where rallies collapse. Trends are currents, guiding momentum. And candles, they're sonar pings, showing where price has touched, bounced, rejected. A long lower wick, buyer defense, a tight doji after a big move, market exhaustion, a series of higher lows, demand building. You don't need 12 indicators to see it. You need eyes, patience, pattern recognition. Take the classic double bottom. It's not magic, it's memory. The market dipped, bounced, tested the same level, and buyers said, this is value. Or a break and retest, price breaks resistance, comes back down, tests the breakout point. Not coincidence. It's collective psychology. People waiting for confirmation before commitment. But charts don't just show history. They hint at probability. They whisper future scenarios. That's why professional traders don't trade what they hope. They trade what they see. Still, there's a trap. Don't become a chart addict. Don't lose yourself in noise. The best traders use charts to simplify, not complicate. They look at clean levels, clear patterns, confluence. 1 or 2 tools, not 12. A strategy, not a system overload. And remember, the chart is not the sea. It's just a snapshot. The storm might still be coming. A news release, a rate decision, a flash crash. So while chart reading is essential, it must live within context, guided by your compass, protected by your anchor, and tempered by your psychology. Because only then does it become what it truly is, a map of opportunity. The internal storm, mastering your trading psychology. You've got the chart. The setup looks clean. You've set your stop loss, defined your risk, double-checked the trend. Everything lines up. You click buy, and then the chart pulls back. Your heart races. You question yourself. Did I make a mistake? You hesitate. Price dances near your stop. You want to intervene. You widen it just a little. Minutes later, SL hit. You've lost more than planned. You slam the desk, open another trade. No setup, no logic, just revenge. Now you're not trading, you're drowning. Welcome to the undertow. In trading, emotion doesn't always roar like a wave. It creeps, quiet, smooth. It waits beneath the surface until you're tired, distracted, or overconfident. Then it pulls you, not because you're weak, but because you're human. Fear, greed, regret, hope. These aren't abstract ideas. They're physiological, chemical. You feel them in your chest, in your throat, in the jitter of your clicking finger. And unless you learn to surf them, to recognize them in real time, they will drag you from discipline into disaster. Take fear. Fear makes you cut winners too early. You're up 30 pips. You think, I don't want to lose this, so you close. But your plan said to aim for 80. You just sabotaged your own edge. Now greed, it whispers after a win. Double the size, you're hot. You forget the plan, forget risk. And suddenly, one bad trade erases 3 days of work. Regret, that's the ghost that lingers after a loss. It keeps you glued to the chart, even when you should walk away. It replays the entry, the could have, the should have. And while you're frozen in that loop, the market keeps moving, and you miss the next real opportunity. Then there's the most dangerous emotion of all, hope. Hope makes you hold losing trades. It makes you move stops. It makes you say, it'll come back. But the market doesn't know you, doesn't care about your hopes. And the moment you start trading what you feel instead of what you see, you're no longer navigating. You're drifting, face down, in a current of your own making. So, how do pros survive the undertow? They systemize their behavior. Predefined entries, predefined exits, trade journals, meditation, breaks. Even walk-away triggers. If I lose 3 trades, I stop for the day. They don't trade their emotions. They trade through them. They also detach identity from outcome. A losing trade doesn't make them losers. A winning trade doesn't make them gods. They separate ego from execution. They seek consistency, not excitement. Because trading isn't therapy. It's not where you come to heal your need to win, your need to be right, your need to conquer. The market doesn't care about your ego, only your edge. So next time emotion rises like a tide, ask, is this my strategy or my subconscious trying to survive? Because unless you master what's happening inside, no setup, no matter how perfect, will ever save you. The news storm, when headlines become hurricanes. It starts with a whisper, a tweet, a statement from a central banker, a single line buried in a press release. And then, the tide shifts. Volatility spikes, spreads widen, the chart explodes. What looked like a calm sea a moment ago becomes a raging storm. And you're caught mid-trade. No umbrella, no warning. Welcome to the news event. In Forex, news isn't just background noise. It's seismic. It doesn't trickle into price. It slams into it. A single number, like the U.S. non-farm payrolls or ECB inflation outlook, can send pairs flying 100 pips in seconds. Why? Because the Forex market isn't just built on facts, it's built on expectations. And news either confirms those expectations or shatters them. Picture this. The market expects the Fed to hold interest rates. Everyone's priced it in. Then suddenly, a surprise rate hike. In an instant, the USD surges. Stops are triggered. Momentum traders jump in. Algorithms pile on. Slippage hits. And if you were on the wrong side of the wave, you're not just losing. You're being erased. But here's the part most traders miss. It's not just the content of the news. It's the reaction. Sometimes good news causes a drop. Bad news causes a spike. Why, Lizzie? Because the market isn't reacting to the news itself. It's reacting to what was already expected. This is why trading news is so dangerous. If you don't understand the difference between data and expectation, you'll be confused every time the market moves irrationally. But it's not irrational. It's ahead of you. So, how do smart traders approach news? They prepare, not predict. They use economic calendars, like the ones on Forex Factory or investing.com, to know what's coming and when. They identify high-impact events like central bank decisions, CPI reports, unemployment data, and during those moments, they either reduce exposure or step aside entirely. Some use straddle strategies, placing pending orders on both sides of a tight range before news hits. Others wait for the dust to settle, then trade the aftermath, the real trend after the fake-out. But the most important thing they do, they respect the storm. They don't trade blindly through it. They don't chase the candle. They don't assume they can out-click the machines. They understand that in a storm, your job isn't to fight the wind, it's to read it. And sometimes it's to wait it out. In 2024, traders who tried to fade the Bank of Japan's surprise rate hike without stops were obliterated. Accounts liquidated in under a minute. Not because the trade idea was bad, but because the timing was arrogant. They underestimated the ocean's wrath. And that's the lesson. News is not a headline. It's a wave. You don't ride it unprepared. You anticipate it, position for it, or get out of its way. Because once the storm passes, the ocean calms again. And that's where real opportunity begins. Finding your trading identity, scalper, swing trader, or macro navigator. Not all ships are built the same. Some skim across the surface like speedboats, zipping in and out of tight corners. Others move with weight and purpose, cutting slow but steady paths across the horizon. Trading styles are no different. And the most dangerous thing a trader can do, sail a ship that wasn't built for them. This is the moment where most beginners get lost. They see a scalper make $300 in 3 minutes on YouTube and think, I can do that. Or they read about a macro trader who held a position for 4 months and doubled his account and think, that's what I want. But they never ask the deeper question, what kind of trader am I built to be? Let's start with the scalper. Scalping is fast, ruthless. You're in and out in seconds or minutes, snatching small pips over and over. It's like threading a needle in a hurricane. High reward, but higher emotional toll. Scalpers trade during peak liquidity, mostly during the London-New York overlap. They need a rock-solid internet connection, razor-sharp reflexes, a clear setup, and zero hesitation. But most of all, they need emotional neutrality. No hesitation on losses, no euphoria on wins, just pure execution. Now meet the swing trader. They're more like mid-range cruisers. They look at 4-hour or daily charts, hold trades for days or weeks. They wait for patterns to form, stories to unfold. They're patient, they don't chase noise, they manage fewer trades, but with deeper analysis. This style suits people with full-time jobs, those who don't want to sit in front of screens all day. But it still demands discipline, because the longer you're in a trade, the more room you give your mind to interfere. Then there's the long-term macro trader, the tanker, the aircraft carrier. These traders analyze interest rate differentials, political shifts, global capital flows. They may only take a few trades per quarter, but when they do, they go big and hold. This requires deep knowledge, thick skin for long drawdowns, and a high level of conviction. It's not about catching moves, it's about positioning before the tide shifts. And here's the truth most gurus won't say. None of these styles are superior. What matters is alignment. You can't force yourself to scalp if your nervous system is wired for reflection. You can't swing trade if you check your phone every 90 seconds. Your trading style must match your psychology, your lifestyle, your temperament. Because your strategy is your compass, but your style is your ship. Choose the wrong one, and you'll always feel off balance, reacting instead of responding, drifting instead of directing. So, how do you find the right vessel? Backtest, journal, experiment with different time frames. Track how you feel during trades, how you behave after losses, which trades drain you, and which energize you. Your trading journal is your mirror. Use it. And once you find your ship, build it, strengthen it, respect it, and never switch boats mid-storm. The training ground, your practice harbor. Before you brave the open ocean, before you test your compass in the storms of live markets, before you risk real capital, there is a harbor, a place to train, to stumble, to get things wrong without sinking your ship. This is the world of demo trading, your practice account. And it's the most underrated, underused tool in all of Forex. Most beginners treat demo trading like a video game. They open random trades, over-leverage, chase losses, blow up the virtual balance in a day, then say, "I'm ready for real money." But here's the truth. If you can't build discipline in a risk-free environment, you won't suddenly develop it when real money is on the line. The pressure of real capital doesn't forge discipline. It exposes its absence. The practice harbor isn't for testing the market. It's for testing yourself. It's where you learn your platform inside and out, so you don't fumble when the real storm hits. It's where you master order types, execution speed, slippage, spreads, where you discover how different pairs behave at different times. It's where you find your rhythm, your rituals, your reactions. But most importantly, it's where you start tracking your edge, backtest your strategy, measure your win rate, record your setups, refine your risk-to-reward ratio, learn what works, not what feels good. And yes, the one thing a demo account can't teach you is emotional pain. You won't feel the sting of losing real money. But what you can develop is emotional preparation. You can observe your impatience, your need to be right, your habit of skipping setups. You can build rituals that become second nature, so when money enters the game, the structure holds. Legendary traders didn't become great by risking everything on day one. They spent months, even years, in simulation, sharpening the blade, training the hand, cultivating the mindset. In fact, in 2025, many trading apps now offer hybrid practice accounts, where your performance in demo mode unlocks real capital from prop firms or communities. The better you trade in simulation, the faster you earn trust, and sometimes funding, without ever risking your own cash. So, why would you skip this step? Why would you dive headfirst into the storm without first learning to float? Here's your challenge. Treat your practice account like it's real. Feel every trade as if it were $1,000 at stake. Take every setup seriously. Log every win and loss. Trade small, trade clean, trade intentionally. Because your trading account, live or not, is a reflection of your habits, not your hopes. And once you've trained in calm waters, once your process becomes muscle memory, then, and only then, should you lift anchor and set sail into the live ocean. The hidden cost, understanding rollover and carry. You close your laptop, the charts stop moving, the world sleeps, but your trade, it doesn't. While you rest, an invisible transaction takes place, one that can quietly build your profits or slowly bleed your balance. This is the rollover, the overnight interest, the subtle tide that few new traders notice, until it drags them unexpectedly out to sea. Here's what most never learn until it's too late. Every open Forex trade that crosses 5 p.m. Eastern Time is automatically rolled over to the next trading day. And with that rollover comes an interest credit or debit based on the two currencies you're trading. You're not just trading price, you're trading interest rate differentials. Let's say you're long AUD JPY. In 2025, Australia's central bank interest rate is 4.35%, while Japan's remains at 0.10%. That means you're holding a high-yield currency, AUD, and shorting a low-yield one, JPY. Result? You earn the difference in interest every night, a small credit applied to your account just for holding the position. That's positive carry. But flip it. Go short AUD JPY. And now you're paying interest daily. That's negative carry. And over time, even if your trade is flat in price, those overnight debits accumulate like sandbags on a sinking ship. What makes rollover so powerful and so dangerous is its invisibility. Many traders wake up and wonder why their balance changed overnight. Others ignore the cost entirely, only to find that a long-term trade that went nowhere still cost them hundreds, or even thousands. In 2024, a wave of new traders went long USD just try to chase quick profits. They didn't account for the massive negative carry due to Turkey's sky-high interest rates. Even as price remained flat, they bled daily, until their accounts eroded, not from loss, but from ignorance. But here's the twist. Rollover can be a weapon. Carry trading, the art of earning interest on high-yield currency positions, has long been used by hedge funds and macro traders. In low-volatility environments, they generate consistent income without needing massive price movement. It's like collecting rent from the market every night. So, how do you use rollover to your advantage? First, know your pairs. Understand which currencies offer high interest and which don't. Use updated tools from your broker to see daily rollover rates. Factor it into your position, especially if you plan to hold for more than a day. Second, align your direction with interest. Don't short high-yield currencies for too long unless you're certain of the move, or prepared to pay the nightly toll. Third, remember that triple rollovers happen on Wednesdays. That's when the weekend's interest is bundled into a single day. And if you're not ready, that Wednesday can feel like a storm surge hitting your balance. The ocean rewards those who see the invisible. The current doesn't just come from news, charts, or emotion. Sometimes it comes quietly, from interest. Learning from disaster, the trade you shouldn't have taken. It started like any other morning. Clear chart, clean setup. USD JPY had broken resistance overnight, riding the wave of a stronger dollar and optimism from a recent Fed speech. You check your indicators. Everything aligns. You enter, confident, precise, controlled. At least, that's what you thought. But within hours, the tide shifted. News out of Tokyo. The Bank of Japan hints at policy tightening. Completely unexpected. The yen strengthens violently. USD JPY plummets. Your position turns red, fast. You freeze. I'll wait. It's just a pullback. Another 40 pips down. This is an overreaction. Another 30. I can't close now. It'll come back. It always does. And then, silence. Not on the screen. In your mind, the storm outside becomes internal. Doubt, anger, regret. You widen your stop. You double your lot size. You abandon your plan. By day's end, you're not trading a strategy anymore. You're trading revenge. This isn't fiction. It's the story of thousands of traders, and specifically of one man in 2023, a 27-year-old finance grad from California who lost $72,000 in 2 weeks trading USD JPY. Not because his strategy was bad, but because his psychology collapsed. He refused to take the loss, refused to surrender, and the market, with no emotion, no revenge, no agenda, did what it always does, punished inconsistency. The trade wasn't the problem, the reaction was. Here's the deeper truth. Most catastrophic losses don't come from bad entries. They come from refusing to exit, from turning a trade into a battle of ego, from needing to be right more than needing to survive. Every trader faces this crossroad. A trade goes wrong. You feel the urge to move the stop, to ignore the signal, to prove something. But in that moment, you stop being a captain and start being a passenger. So, what can we learn from this? First, no trade is worth your entire account. None. No matter how perfect the setup, how many confirmations, how strong the trend, if your position size is too large, if your stop loss is theoretical instead of real, you're walking a cliff blindfolded. Second, have a maximum loss per day, a circuit breaker. If hit, you stop. No questions, no exceptions. Your job is not to win today, it's to trade tomorrow. Third, journal your emotions before and after each trade. Note what you were thinking, feeling, why you entered, why you exited. Because in this ocean, the real enemy isn't price, it's unacknowledged impulse. Every losing trade is a tuition payment, but only if you learn. So ask yourself, what trade are you in right now, mentally, emotionally, that you shouldn't be? The silent killer, why most lifeboats fail. It doesn't happen with drama. There's no explosion, no cinematic crash, just a quiet line of text on your screen. Position liquidated. And in that moment, you realize your lifeboat had holes in it all along. Margin calls are silent killers in Forex. They don't ask for permission. They don't knock before entering. They just happen. One moment you're managing a trade. The next your broker closes it, not because you chose to exit, but because your margin level fell below the threshold. And in 2025, that threshold is tighter than ever, as brokers adapt to regulatory pressure and faster volatility cycles. So, what went wrong? It starts with misunderstanding margin. Many traders think of it as a buffer, a safety net, but it's not. It's a requirement. Your broker sets a percentage, say 1%, that you must maintain relative to your total open positions. So if you have $1,000 in your account and open a trade worth $50,000, you're already stretching. Add drawdown, that margin level drops fast. And when it crosses the broker's danger zone, usually around 50%, the platform doesn't ask questions. It cuts your position. Maybe part of it, maybe all of it. Either way, it's out of your hands. This is where most lifeboats fail. They assume they'll have time to adjust, time to close, time to fix it. But in high volatility moments, like after central bank decisions, geopolitical surprises, or flash crashes, prices gap, slippage spikes, and margin calls don't give you a moment to think. They just pull the plug. It happened in 2023 to thousands of traders during the Swiss franc flash move. Even those with stop losses in place saw them skipped. Why? Because price jumped over their stop and margin calls kicked in before manual control returned. It wasn't personal, it was mechanical. So, how do you keep your lifeboat from sinking? Trade smaller than you think you should. If your broker offers 100.1 leverage, use 10.1 or 5.1. Survival beats speed. Use a margin calculator before placing trades. Know how much room you really have. Don't open multiple trades just to feel active. A common trap. Traders feel idle if they only have one position, so they open 3 more. Now their usable margin is thin, and one big candle can chain react the whole portfolio. Set alerts at 100% margin level. Don't wait for the 50% threshold to sound the alarm. Know when you're approaching danger, and exit on your own terms, not the broker's. And finally, don't treat available margin like extra cash. It's not an invitation to trade more, it's your oxygen supply. Respect it. Because in this ocean, the storm doesn't always come loud. Sometimes it comes in silence, through math, through mechanics, through the invisible hand of liquidation. The art of scaling, float first, fly later. Everyone wants to scale. It's the dream, turning $1,000 into $10,000, going from mini lots to full positions, doubling up, getting funded, replacing the 9 to 5. But scaling isn't about pushing more money into the market. It's about proving you can float first, that you can stay steady when the water gets choppy, that you've earned the right to sail farther. Scaling too soon is one of the top killers of promising traders. You make a few wins, your confidence surges, you double your lot size, and suddenly, the same loss that used to sting, now burns. Your emotional balance shatters, your strategy falls apart under pressure it wasn't designed to carry. This is the paradox. Scaling is not about trading bigger, it's about trading better. Ask any professional trader. They'll tell you, your first goal is not to make more, it's to lose less. To show you can stick to your edge, to demonstrate emotional discipline, trade after trade, week after week, and once that discipline becomes muscle memory, only then do you add size. Think of your trading journey like flying a plane. First, you taxi, then you lift gently, then you rise. Scaling is the increase of altitude. And without engine control, without instruments, without preparation, you don't fly higher, you stall, and stall leads to crash. So, how do the pros scale? They start with performance metrics, not feelings. Win rate, risk-to-reward ratio, drawdown, expectancy. If they're solid for 50, 100 trades, then they size up, not before. They also use dynamic position sizing, adjusting based on trade quality, volatility, and recent performance. If the market's choppy, they scale down. If they're in a clean trend with momentum and structure, they scale up, but still within rules. And most importantly, they scale the process, not just the position. More trades, more documentation, more risk, more self-review, higher capital, higher psychological awareness. In 2025, more prop firms than ever are offering scaling plans, starting you with $10,000 or $25,000 in demo capital and unlocking $100K plus as you prove consistency. But they don't reward flash. They reward structure, floating, not flailing, clarity, not chaos. Here's the litmus test. Could you take a week of back-to-back losses and still follow your plan the same way, at double the size? If the answer is no, you're not ready to scale. Because scaling is not a moment, it's a milestone. It doesn't mark the beginning of success. It confirms the foundation is strong enough to hold growth. Float first. Prove you can handle small waves. Only then can you ride the wind and fly. The ultimate evolution, becoming the whale. You rarely see them. They don't tweet their profits. They don't live stream their entries. They don't chase pips or flare signals with neon arrows. But when they move, the entire ocean adjusts. Prices tilt. Trends bend. Liquidity parts like a tide pulled by the moon. And these are the whales, the master traders who control size, shape market behavior, and operate with a stillness that hides seismic depth. But here's what most don't understand. Whales didn't start big. They started disciplined, focused, intentional. Their size is not what makes them powerful. Their restraint is. So, what does it mean to become a whale? It starts with detachment. Whale-level traders don't obsess over individual trades. They think in series, in outcomes over hundreds of positions. They don't ask, will this trade win? They ask, if I take this trade 100 times, what's my edge? That shift changes everything. It removes emotion. It injects math. It replaces noise with clarity. They also understand the ecosystem. Whales know where retail stops lie. They know where liquidity pools sit. They use this knowledge not to manipulate, but to avoid traps others fall into. They don't chase price. They set ambushes. They wait for price to come to them. Patience is not a virtue, it's a weapon. And whales don't fear silence. They can sit flat for days, weeks. They don't need to be in the market to feel active. They know the ocean is always moving, but opportunity is rare, and that's what makes it valuable. They manage risk like oxygen. Every position is sized in proportion to survival. A single loss is meaningless. Even 10 losses don't shake the structure. Because the whale doesn't drift, it glides. They are strategic. When they scale, it's not sudden. It's structured. They protect drawdowns like sacred ground. They know when to press, when to hold, when to walk away. They see the market not as a casino, but as a reflection of behavior, of energy, of imbalance. They learn to read it like a current. And perhaps most importantly, they are invisible, not because they hide, but because they don't need attention. Their fulfillment comes from mastery, not from metrics. Their confidence is quiet, their approach is calm, their outcome is inevitable. To become a whale is not to grow bigger, it is to grow deeper. So, ask yourself, are you building a trading life that leads toward silence, toward clarity, toward power wrapped in stillness? Because in this ocean, the loudest get washed away, but the quietest move everything. Your new beginning. Sail with mastery, not momentum. You've just crossed the ocean. You've felt the tide that traps beginners and learned to float. You've seen how fear drags traders down and built emotional armor. You've discovered that leverage without control is a sword turned inward. That pips are not numbers, but pressure points. That news isn't information. It's a storm. That practice accounts aren't toys. They're training grounds. And above all, that trading isn't about beating the market. It's about knowing yourself. You now understand that every chart is a map, every rollover a current, every stop loss a lifeline. You've seen why most lifeboats fail, and how whales don't swim louder. They swim deeper. So now what? Now you choose your waters. You decide whether to drift or navigate, to chase every candle or follow your compass, to hope or to execute. This journey wasn't built on tricks or hacks. It was built on timeless truths, on structure, on mindset, on the awareness that in the largest financial ocean in the world, the most dangerous thing isn't volatility. It's your own undisciplined emotion. So here's your invitation. Don't just be another ship lost at sea. Be the sailor who studies the winds, who respects the weather, who sharpens their tools before each voyage. Be the one who doesn't shout, but listens, who doesn't chase, but attracts, who doesn't fear the next wave, because they've learned to ride it. If this resonated with you, if you're ready to transform from drifter to navigator, drop a comment below. I sail with strategy. Because you're not just watching, you're transforming. This is more than a video. It's your new beginning. And remember, the market doesn't drown you. Your habits do. Build better habits. And you'll not only survive the ocean, you'll move through it like a whale.